Alright, my name is Richie and today I'm going to be doing ratio analysis for my Intro to Finance class. And in this project, in this presentation, we were asked to analyze 3 different companies for 3 different questions. The 3 companies I chose was Exxon, Chevron, and Caterpillar Industrial Supply. So first we're going to ask the question, who would we give a short-term loan to? And the company, well, we took 3 different ratios, which is cash, current, and quick. And these 3 ratios were the best ones used to determine how liquid each of these companies are. So the first one we're going to analyze for a short-term loan is ExxonMobil. Now, cash ratio is cash over their entire assets. Current ratio is their current assets over their current liabilities, and quick ratio is all their current assets except for inventory. So it's current assets minus inventory over current liabilities. And you can see here they are lined up. Typically, current's going to be the highest, quick's going to be a little lower, and cash is going to be at the bottom. So the most important one you want to take into consideration when it comes to short-term loans is cash, but it's still important to keep in mind the other 2. So we look at Exxon, we have 0.12, 0.16, 0.15. It kind of declines a little bit as we get closer to 2014. If you look over here at Chevron, a little bit of a higher numbers. It doesn't decline as much. We actually have a peak in 2012. The current and quick are still looking good, so there's nothing, it's not completely liquid. It's not something that could fall apart easily. And then Caterpillar is just a lot lower than the other ones. The current ratio is still kind of good, but in terms of cash, it looks like most of their current assets are inventory. So I chose Chevron for my short-term loan because it had the highest cash ratio, highest quick, and highest current. It actually had all 3 ratios as the highest, so I chose to give them a short-term loan. Now, long-term loan, longer period of time, we're talking 5 to 10 years. You want to take into consideration not how liquid, but how easily they can afford their debt. Now, the equity multiplier is assets over equity by definition. It shows how much liabilities do they have in total. And then the times interest earned is earnings before interest and tax over the interest expense. So this says how easily can they pay off their debt? How much space do they have to work with? Now, the graphs are kind of hard to see because we have 2 different scales completely. This is a multiplier and this is more of a dollar figure. But you can see they have a ridiculously large peak in 2013. So you definitely want to make note of that and focus more on the trend. They must have had a good year. The equity multiplier didn't change nearly as much as times interest earned, so they just probably had a good year of sales. Now, Chevron's definitely a unique circumstance. As I was doing research on this, I couldn't find any times interest earned, and I further investigated. I was like, well, where's their interest expense? So if I went to the balance sheet and there was $0 claimed for interest expense. Further analysis figured out that they, instead of classifying all of their loans as an expense, they capitalized it. They put all of their interest towards research and development. Research and development, it's not on here, but it shot up for Chevron, so they didn't claim anything for interest expense. Therefore, times interest earned was just null. It was 0. It was undeterminable. So that kind of hurt Chevron a little bit. Not saying that Chevron's doing poor, not saying that they're doing great. It just makes it a little fuzzy to determine. Now, Caterpillar has a really high equity multiplier. I mean, we're talking 6s. This is 3 times as much as what Exxon had. Times interest earned is a lot lower than the other ones. They're not looking too good in terms of short-term loans. The graph looks better because they're a little more relative. It's easier to read, but that's because their equity multiplier and times interest earned are a little closer together, which doesn't mean anything good necessarily. So I chose Exxon to get the long-term loan. Exxon had, a good equity multiplier, good time interest earned. I didn't count Chevron. They had no times interest earned. Even though that they were a little less risky, they had a lower equity multiplier. It was closer to 1. We couldn't determine how easily they could afford their interest and their tax. So the last thing we looked at, or are going to look at, is would you buy 50% of a company? Now, we use profit margin, which is net income over sales, return on assets, which is net income over assets, return on equity, which is net income over equity, total asset turnover, which is sales over asset, and then price to earnings ratio. And we have one more that we're going to include in this that's not on that slide, and that's the EM right here. But I'm going to go back if I need a reference for the equity multiplier for these companies. Now here's Exxon's stats. We have a profit margin of 8.9, 9.47. It's looking pretty stable. Good year in 2012 like before. Return on assets, 11.37. They overall look pretty stable. And that I feel whenever if I were to invest in 50% of a company, stability is key. You want a company that's stable, nothing's looking too bad here. Now, of course, you got to compare it to the other companies, see who's doing better. Chevron's numbers are looking higher for the first two right here. Return on equity is not as high. Total asset turnover, lower. Price to earnings, lower. And it's really hard to tell with Chevron. I can't help but think that they have $0 in interest expense. That completely made me uninterested in Chevron. It's a little fishy. I don't know what they're going to do, what's going to happen. Is research and development really worth it that much? This could lead to something bad in the future. And this is interesting. Caterpillar had a ridiculously high return on equity in regards to the other ones. I mean, in 2011, they had 41.57, you can see right here. That's really high. So you would think at first, oh, Caterpillar has the best return on equity, shareholder, that'd be great. Not necessarily, because if you go back, and whenever we were looking at long-term loan information, the equity multipliers in 4s and 6s, making it 3 times as risky as Exxon. So it was really between Exxon and Cat, but I chose ExxonMobil because they were less risky, they had better stats than Chevron. Everything else, other than the return on equity, was better on Chevron. I mean, we have 6 and 4 as opposed to 8 and 6, and the total asset turnover is nothing. It's lower than 1. This is the only company that's below 1, and then price to earnings isn't that good. So I chose to buy ExxonMobil 50% ownership. Thank you for watching this, and have a good day.